Let's go through, you mentioned the CPI. Well, the CPI did jump up from 2.4% to 2.7%. As you say, the first jump we've had for quite some time. And everyone's interpretation was, well, this is Trump's tariffs. So that's one number. Now, the second number is the producer price index. And the producer price index stayed constant at 2.3% year over year. And in fact, the 50 analysts that report to Bloomberg on forecasting the PPI, they were all wrong. They all said it was going to go up. Well, it's flatlined. It didn't do anything. And they said it was going to go up primarily because of tariffs. So if you look at those two numbers, we really get kind of a mixed picture going on. You basically have a lot of noise. You got the CPI going up, the PPI flatlined. And I would also add that before this, to make things even more confusing, is that the spin meister in the White House is Kevin Hassett. He's the top economic advisor of Trump. And this past Sunday on CNBC, he said that the CPI had reached its lowest level in a decade, which is blatantly false. It's not true. But there are a lot of untrue statements that come from the White House or from Washington, D.C. in that regard. So there you have the picture. You got a lot of spin going on and interpretations and so forth. My take is the following. We are still in a downward trajectory for inflation, and the reason for that is that inflation is always and everywhere a monetary phenomenon. So you have to look at what was going on a couple of years ago with the money supply to get some idea of what's going to be happening with inflation today or tomorrow. And since the money supply 2.5 years ago was actually contracting, it would indicate that we'd stay on this downward trajectory, and that would be the major force moving the overall price index. However, we do have to put a caveat in here, and that is that some of these tariffs, which is nothing more than a one-time tax, by the way, eventually, depending on how they're imposed, what level they're imposed, what countries, we still don't even know that. And the reason for that is that Trump has no tariff plan. He doesn't know what the word plan means. The thing changes from hour to hour. But as soon as the dust settles, some of that will come in and be reflected in relative price changes on those items that are taxed with the tariff. And we could see some temporary ticks up in the price index, so that it is possible. But these are one-time blips in the price index, and then it starts going in the direction dictated by changes in the monetary policy. It's like a depreciation. If you have a very open economy, for example, like the United Kingdom, trade is a big chunk of GDP in the United Kingdom. So if you have a big depreciation in the pound sterling, that will cause a one-time blip up in inflation. And then things start moving in whatever direction is being dictated by monetary policy. So it's all a matter of, shall we say, nuance and so forth, rather than spin. In this case, because it's picking up, commodities and inputs, and those commodities and inputs are going to be directly affected by the tariffs, for example. So if you want to look at the effect of a change in the exchange rate on price indices, PPI is better than CPI. And I think that's also true with these tariffs, because tariffs, in a way, are pretty close to changes in exchange rates and how they work through the system. And by the way, back to your question, one thing, producer price index, it's all focused on what we call tradables, things that are traded in international trade. And those things are affected by what? Tariffs. Tariffs affect tradables, and changes in exchange rates affect tradables. The non-tradables, like housing, you can't trade land in the United States for land in Taiwan or something like that, or Canada, or whatever have you. And you can't trade a house in Canada for a house in the United States, unless, of course, that would exclude mobile homes. At any rate, you get the point. That's why keeping your eye on the PPI will be important going forward. More important than is normally the case, because we'll have an intervention, mainly the tariffs, that are actually working their way and affecting things on the tradable front. The one thing that is important to realize is that there's more to tariffs and the threat of tariffs than meets the eye, because they basically are a weapon. They're like sanctions. If you put a tariff on Canada, you're launching an attack on Canada or whatever the country happens to be. Especially like in the Canadian case, just for example, Trump is running a master class on how to make enemies. The snowbirds are mad as hell at the United States. They stopped coming to the United States. The touristic activity coming from Canada has dwindled down to virtually nothing. Because why? They're mad at Trump. Now, let's go to Russia. Russia, the 100% tariffs would be secondary tariffs, or like secondary sanctions. If India and China keep buying Russian oil, which they buy a lot of, by the way, they would be faced with 100% tariffs for anything that they wanted to export from India or China to the United States. Now, number one, does this make much sense? What the hell does this have to do with Russia? It's a secondary thing, a second order thing. So we're in a war with Russia, and don't kid yourself. This is Trump's war now. It was Biden's war. Now it's Trump's war. He's sending more, continuing to send money to Ukraine, send weapons to Ukraine. So the U.S. is in a war with Russia. Now he wants to threaten a potential war with China and India. That's what these secondary tariffs are. So that's why I say Trump has turned into a master class on how to make enemies. From U.S. point of view, the chickens will come home to roost eventually, where the U.S. will have so damn many enemies by the end of this thing, you won't be able to shake a stick at them. Let's talk about tradables, those things that are largely affected and come up on the producer price index. And then the overall consumer price index, which includes everything. It includes the raw material inputs, the intermediate production, and other items, including a lot of non-tradables. So I would anticipate that the non-tradables would keep coming down under the pressure of this anemic growth in the money supply. And when I say anemic, it hasn't moved much in total for about 2.5 years. And the rate of growth in the money supply now is only 4.5%, which is way below Hanke's golden growth rate of 6.3%, a rate consistent with a 2% inflation target. So I think the non-tradables will actually be under pressure to be coming down. The tradables, it's another story. It depends exactly on how these tariffs are imposed and at what levels are imposed. But that's what we want to keep our eye on. As more of these tariffs get locked in and we know more about them, we'll be able to see the effect of that coming through the producer price index, because those are all tradable goods and services. Well, his people have given him bum information because he looks at the federal funds rate and he wants the federal funds rate to be reduced by 3 percentage points, okay? And he looks at the difference between the federal funds rate now and with the 3 percentage point reduction. And he multiplies that times the financing required by the federal government to service the debt. The problem is the government does not borrow at the federal funds rate. That's essentially irrelevant. It's a spurious kind of thing to be making a calculation like that. The average duration of Treasury securities out there now in the market is about 6.5 or 7 years. It's not a spot rate like the federal funds rate, but the government doesn't borrow at that rate. So they've made the wrong calculation. And like many things coming from the White House, it's just rubbish. It's irrelevant. Let's talk a little bit about Trump and Chairman Powell. Neither one of them have a good grip on monetary policy. And let me first start with Powell. You and I have gone over this over and over and over again, ever since COVID started. Powell has a terrible record as the chairman of the Fed, and he's had us on a roller coaster. Money supply goes up. Inflation goes up. Then money supply contracts and inflation starts going down, up, down, all over the place. And the reason for that is that he thinks looking at the interest rate is an indicator of monetary policy. No, interest rates are not an indicator of monetary policy. Changes in the money supply indicate what's going on with monetary policy. So he's got it all wrong. He's testified on this over and over again. He does not think the money supply has a bearing on economic activity that's reliable, and he rejects, and all the staff of the economists at the Fed reject the quantity theory of money. The whole idea of the book Matt Sakurki and I just wrote, Making Money Work, is to put the quantity theory of money back in the picture. So that's where we are with the chairman. Now, the president has essentially the same view. The president thinks monetary policy is all about interest rates. He never talks about the money supply. He's always talking about interest rates, always irrelevant. So both Trump and the chairman, I would give a letter grade F to. If they were in my class, they'd both get Fs.